Hello, welcome to another great educational webinar here at Advanta IRA. Gonna touch base on something that's very timely as we sit here on March 13th of 2025 with what's going on in the world around us in the last couple of weeks, whatever. Very timely topic today to talk about the 2025 precious metals landscape. Very happy to have Greg back on today with us. We'll let him come on in just a couple of minutes. Like I said, very timely event with what's going on in the different markets, in the company and the economy as a whole, and not just in the U.S. but also globally as well. I'm your host of the webinar today, Scott Maurer here, the Vice President of Sales at Advanta IRA. Been with the company for since 2006, educating people on self-directed IRAs, retirement accounts, everything that's possible, what you can do as far as different types and unique investments. And like to always bring great educational content to you today. That's why we have had Greg with Allenhouse Metals come on again. He's been on a few times in the past as well, always giving us some updates on what's going on in precious metals and maybe how you can best protect those investments in your portfolio, or maybe look to add those as part of your portfolio as well, and really the hedging against some of the inflation, some of the other aspects of the economy, what is going on. Just a quick disclaimer, our events that we promote, the webinars, are always educational in nature. If you're looking at making investments, either with the parties that we are talking to or that are talking to you on the webinar, and that we bring on, certainly do your due diligence on them, on the investments themselves that you're looking at purchasing. And you can always consult with attorneys, accountants, financial advisors for any tax, legal, or investment advice. That's something we cannot do at Advanta IRA. We do not provide any specific investment advice or endorse really any product, any provider, really any type of investment. We kind of give you a blank slate to invest in things that you want to invest in. It's up to you to be comfortable, obviously, with what you're looking to do with your retirement accounts. Just a quick note about Advanta IRA for those of you who are unfamiliar with us here at Advanta. We've been around for over 20 years. We really pride ourselves on our customer service experience, giving dedicated account managers that specific level of concierge service to every individual client and referral partner. We currently have over $3 billion in assets under management with over 14,000 active accounts. I did have a question pop up in the question box already. Said, are there any handouts available? And the answer is we can certainly make the slides available to you after the presentation. They're not attached in GoToWebinar, but we can certainly email them to you after the presentation is over. Which, a great reminder for those of you who live on the call today, if you have questions for myself about self-directed IRAs, type those into the question box as we bring Greg on to talk more about precious metals. You can ask questions through the question box in your GoToWebinar screen. Again, we also, in addition to the concierge level of service that we give to all our clients, we like to provide a lot of great educational events, webinars like the one that we're on today. We get out to a lot of networking events in places close to our offices in Tampa and Atlanta and Charlotte. We also do a lot of virtual networking events. We have a Pitch, Promote, and Prosper event that occurs typically the last Friday of every month, and giving everybody a chance to come on, talk about investments that they're looking to buy, maybe they're looking to sell. So check out our website and our events page. You'll see a lot of great information there when it comes to upcoming events, places we may be. We have a podcast as well, the Alternative Investing Advantage podcast. That's hosted by my colleague Alex Perney. Does that on a weekly basis. Again, a lot of different topics, a lot of different speakers, similar to our webinar series. Alex likes to bring in a lot of unique voices and perspectives to that podcast as well. As we talk about precious metals today, I do want to have Greg get most of the floor today and have most of the time to talk about the precious metals markets and what's going on, what to look out for. Just a couple notes about buying precious metals inside of an IRA. In general, there are some coins that are, there are things that are collectibles are prohibited as investments inside of an IRA. There's two types of assets that are prohibited inside of a retirement account that you cannot buy, and those are life insurance and collectibles. And certainly the collectibles like rare coins, rare stamps, things like that are not permissible inside of an IRA account. But the IRS does make an exception for certain types of precious metals that meet certain fineness requirements. Typically, the metal that you're purchasing needs to be at least 99.5% pure, the gold, silver, the platinum or palladium coins. You want to note, though, that not just because a coin is minted by a government doesn't automatically make it qualified for an IRA account. Certainly, gold and silver American Eagles are permissible. They are minted by the U.S. government, but not every government. I think Canadian maple leafs are also permissible inside of an IRA account. But just because there's a government that mints the coin doesn't necessarily make it qualify. That's why you'll want to rely on the gold, silver, the precious metals dealers, someone like Greg, who can make sure that you're staying within the ropes of what you're buying with your IRA account when it comes to physical metals. If you're looking at buying metals in an IRA account, you do need to have a separate depository set up for your IRA to actually physically custody and store those particular metals. The IRS does not permit you to have personal possession of any metals you buy with your IRA. So your IRA may purchase the metals, but those metals then need to be stored at a third party depository. You cannot have physical possession. There was a case a couple years ago, the McNulty v. Commissioner case, where an individual, actually a husband and wife, used their IRA accounts to buy precious metals. They did it through an LLC. So they set up their IRA with a checkbook LLC, and they then thought because they had structured their investment that way that they could now then personally custody their metals. Unfortunately for Mr. and Mrs. McNulty, they were wrong, and the IRS deemed their personal possession of the metals to be a prohibited transaction within their IRA account. And just though, although precious metals coins could be used as legal currency, you cannot use metals as a contribution to your IRA. So with a lot of, all IRAs, you're allowed to put in up to $7,000 or $8,000 a year of new money out of your pocket into an IRA as an annual contribution. We're coming up on the April 15th deadline, where a lot of people make those contributions. Your contributions do have to be made in cash. You cannot contribute coins that you own personally to the IRA account itself as that annual contribution. As again at the bottom there, make sure that you're working with a gold dealer who knows what products meet that IRS investment grade criteria. Do your due diligence. Make sure you're satisfied with what you're paying for those particular coins or those bars that you're going to purchase within an IRA. So when you're buying metals, we always like people to understand the difference between what the spot price of the gold or silver is and the price that you're paying. It's going to be a little bit different. The metals dealers, they're out there buying and selling. They are in a business. They're looking to obviously run a profitable business. So there's always going to be a little bit of a spread between the spot price and what you're paying. Those spot prices and the price you're paying can vary from one dealer to another. So make sure that you understand the differences between that. Again, understand what metals are acceptable to purchase. The need, as I mentioned, to hold metals in a third-party depository. And one other note that the process when you're doing a purchase is time sensitive. If you are working with a gold or silver dealer and they're purchasing these metals based on a verbal understanding of what that price is going to be, we still need you to approve certain documents for us or complete certain documents for us before we can release money from your IRA account to make that purchase. So you need to make sure you're available when you're going through this purchase to quickly also sign our paperwork so we can get that all handled within a day, maybe 2 days at the most. And we cannot give you advice as to the quantity, price, or the type of metals you are purchasing. That again is going to be up to you, talking with your precious metals dealer to decide on exactly what quantity and what types of metals that you're looking to add to your IRA portfolio. We do have several different depositories that we work with, and a couple questions have come up in regard to that. I'll get those answered here before we bring Greg on. We currently have a list of, I believe, 8 or 9 different depositories that we work with. And that's typically that list. Somebody asks, are we willing to add additional depositories to our list at this time? I don't believe so. I'd be happy to talk offline about that, but we are satisfied with the 8 or 9 different options that we have now. If you find, though, you working with a particular dealer and a depository that they use, it might be possible for us to then add a different depository to our list. So just again, that's maybe a question to bring me offline. Um, Another question popped up: is a safe deposit box at a bank considered personal possession? I can't answer that question from a definitive answer. That's more of a question the IRS would answer. My guess is that since you have access to that safe deposit box personally, the IRS would likely consider that to be personal possession. That's just my thoughts on it. The IRS does want you with your IRAs to be hands off. So if your IRA owns the metals, you should need to go through your administrator, go through Advanta in this case, go through us to have the authorization to release the metals to you or to sell the metals. If you are able to do that without our input, from that perspective, or going to a third party like a depository to release the metals, my guess is that's the issue that they have. So I would shy away from using a safe deposit box. I'm not saying that the IRS would definitely have a problem with it, but I think that's certainly an issue that you might run into. All right, so that's a little bit about precious metals in an IRA. If you have more questions on that part of the process, how it works, what's involved, how to set up the IRA to do it, move cash over to do it, let me know. Happy to answer questions. I'll have my contact information up again at the end of the webinar today. But at this time, I'd like to bring in Greg Allen of Allenhouse Metals, who does offer the purchase sale and has certainly storage solutions as well for the precious metals that you can purchase through him. He's a frequent speaker. We've had Greg on a few times before. He always brings great information. He always likes to come on and update us as to what things are going on in the markets that certainly affect the precious metals market. There's been a lot of movement the last few days, a lot of different things going on. Again, not only in our country and other countries as well that are going to affect these markets. In fact, just as a side note, when we do these presentations, I usually ask a presenter to get me their slides a couple days in advance, maybe 4 or 5 days in advance. Greg asked me, said, hey, can I wait a little bit to get this to you? There's more information coming out the day or two before our webinar. He said there was even information it was coming out this morning that he could not add to the presentation. So it is that timely of information as we talk here today. So this time I'll make Greg the panelist for the webinar, invite him to share his screen. Greg, how you doing today?
Good, thanks, Scott, and thanks for having me on again. Like you were saying, there's stuff up to the minute here of data coming out. I know everyone here, I'm sure, is seeing stuff about tariffs and new information on that's coming out. So there's a few things we'll talk about today that might not be on a slide just because of the timeline there. The one thing I do want to emphasize, and I know you said this too, is do not hesitate to throw questions up as we go through. We're going to go over a lot of different things today, and there is no such thing as a stupid question. So feel free to ask them. I'll answer them to the best of my ability, and hopefully you'll have better understanding when we're done here today. Just moving on here from the top down type of thing. Our core values here, we really believe metals are just like anything else. There are absolutely no one size fits approach, right? At the end of the day, we want to understand, your objectives and really help you tailor fit your investment in your portfolio that best meets your investment needs, right? People have different priorities, whether that be capital appreciation, just preserving your purchasing power rather. And I think right off the top, one thing I do want to emphasize is, we are not by any means a coin dealer, right? We typically try to stay away from coins. We specialize in what's called investor bars. So these are kilo and 100-ounce bars of silver, kilo and 10-ounce bars of gold and platinum. And everything that we sell and buy back as well are all COMEX, LBMA approved. We like these products because they trade on an open market. There's no bartering over them. The price is the price, and you're liquid at all times. And I think that's really important. The one thing I want to emphasize, and I say it because it's come up a lot lately in clients that we've helped out of certain situations. If you're going to buy a coin, because there are good coins out there that you can buy in your IRA, not everybody is putting a huge chunk of money into gold and silver to where they can buy a kilo of gold, right? If you're going to buy a coin, stick with a normal, conventional, an American Eagle, a Canadian Maple Leaf, a South African Krugerrand, these types of government minted coins. If you start seeing or hearing, a specific year or a vintage year, or you see the word proof, proof by definition from the mint is a collectible. You see a lot of dealers sell these proof coins in IRAs. They can try and get around it all they want. It's really just an excuse to charge you a higher premium. It doesn't mean it's worth more at the end of the day when you go to sell it. And so I just want to make that disclaimer from the top here to emphasize, at the end of the day, you're buying metal by the weight, and you want to buy product that is going to have the thinnest spread between the buy and the sell at the end of the day. And those are investor bars. So,
and Greg, really quick, if I could, somebody had a question exactly on that, so I just wanted to make sure we get this question answered as you were talking about it too. And just a note on that again, at Advanta IRA, we're relying on you. You're relying on your metals dealers to make sure that what you're purchasing is correct. If you send us an invoice and approve it, we will purchase those metals. So you want to make sure that, as Greg said, you're getting that kind of question answered as to what you're purchasing. And the question that came in, Greg, was what differences are there in terms of liquidity, volatility, and risk between so-called collectible or premium gold and silver coins and those more common, like the Maple Leaf, American Eagle, etc.? To what type of investor are those two different offerings target? Again, there's two answers, I guess, to the question. If you're investing in an IRA, you have to be careful that you're buying an IRA approved one. Outside of an IRA, obviously you can purchase whatever you want in terms of collectibles and things like that.
Yeah, and I think the thing is proof coins in general are not something that you should be buying as an investment. You can go on the United States Mint website and see they'll advertise these proof coins at a huge premium in sets and box sets, and they're beautiful, don't get me wrong, but they're established for someone that's looking to collect. And there's nothing wrong with having a coin collection, but it won't perform like it would if you just bought, the bare bottom coin. We see in certain instances, I'm dealing with a few clients right now that dealt with other companies and bought proof gold eagles or proof silver eagles. Just because these are special collector sets, these people were charged premiums upwards of 70%, 70. Like it's insane. So don't subject yourself to that type of situation. It's really not worth it. And I would say at the end of the day, the thing as far as a standard gold eagle goes or a standard gold bar, their premiums in terms of between the buy and the sell on it are going to be roughly the same. You're going to pay more of a premium for a 1 ounce gold eagle than you will for a kilo bar of gold. But when you sell it, you're going to sell a 1 ounce gold eagle for more per ounce than you would a kilo of gold, if that makes sense. So just to get down to brass tacks on that, the big thing is we want to avoid collectibles, and any type of rare coin is always going to come along with a high premium. It's a bait and switch, right? A lot of the time they're sold as, if you buy this pre-1964 coin, it's not taxable, all of this type of thing. Well, you're buying in an IRA anyways. Everything within your IRA is tax protected. It's tax deferred, so to speak. So, that's one thing to keep in mind. Now, just kind of getting back to who we are. So we work exclusively and directly with a company called Dill & Gage. Dill & Gage is the authorized purchaser for the United States Mint, Canadian Mint, South African Mint, Australian Mint, virtually every government mint around the world, okay? They do not deal at a retail level. They import about $1.5 billion of gold and silver and platinum on a monthly basis. And so we deal with them exclusively. We distribute from them. This allows us to have access to a bigger inventory than pretty much anyone else. And we have everything under the sun, and it allows us to be very price competitive. we can't be beat when it comes down to price. Now, as far as depository goes, I know, Scott was talking about they have 8 or 9 great options for depositories. We're happy to work with anyone, but IDS Texas specifically is who we prefer to work with. They do have a Delaware location as well. IDS is a wholly owned subsidiary of Dillon Gage. So the reason we recommend IDS Texas specifically is it's in the same building in Dallas as our distribution center. So it helps us facilitate trades, buys, and sells much quicker. The fees are very competitive. And I'm in Dallas today, and after the webinar, I'm going to be taking clients to audit the vault. And so one thing IDS does that's unique is in your IRA, while you can't hold the metals, you are able to schedule an appointment, go into the depository, and you can audit all of the metals that are in your IRA. You can go through everything, top to bottom, which is, it's a cool thing to be able to do. And everything in there is covered by an all-risk Lloyd's of London policy, meaning if anything were to happen to the depository, no questions asked, you're compensated by the insurance. So, I mean, moving on here, I think the number one thing for gold and silver right now is you're looking to find a true safe haven, right? And what is a safe haven, I guess you would ask? I mean, the thing about gold and silver that makes them a safe haven is they're guaranteed to hold their intrinsic value, right? On top of holding that value, they rise over time with the cost of living. So the general idea is this: if you, let's say 100 years ago, you were to go and buy a house, and let's say the average price of a house was $3,500. If you bought $3,500 worth of gold 100 years ago, and today the average price of a house is a lot more than $3,500. In America right now, it's $489,000. Well, that $3,500 worth of gold 100 years ago will buy you the same house. It's actually outperformed inflation. So you would require less gold today to buy that same house for $489,000 than you would to buy that house for $3,500. And moving on here, in times, and this is very important because it's what we're seeing right now, in times of economic turbulence, geopolitical tensions, we typically see paper markets plunge with the uncertainty. And at the same time, we see precious metals soar in value. So there's studies that you'll see today as we go along that'll show you how important it is to have precious metals as a part of your portfolio, as they've consistently outperformed equities and real estate for over 50 years right now. And so I think it's important to note, not only are they a safe haven for your portfolio, but they're a consistent performer for your portfolio. They can, perform for you in down markets and up markets year in and year out. So moving on here, one of the major things that's affecting markets right now are tariffs, right? We started out with tariff fears, and I think you could sufficiently say we're in the midst of a trade war now. Some of the tariffs have just been released this morning that aren't even on here yet. And one thing that I want to emphasize is, getting into these tariffs, we're not speaking about anything politically or political preferences. We're simply looking at these as how they are affecting global markets and how they're going to affect the economy to come. And one thing I think is a really important perspective to look at, why the tariffs now, and Trump's perspective on this. One of his close partners that he's done a lot of business with explained it this way: Trump is a big free market advocate. And so his perspective is, if we're going to open up our market in America to you, we expect you to open up your market to us. And so the primary goal of these tariffs is twofold. Okay. First off, they want to have reciprocated free trade. Like we're talking, whether it be with the EU, with Canada and Mexico. But if someone is going to charge the United States tariffs and we're going to face a deficit because of that, he is going to come to the plate and do that right back to them. Now, in an interview this week that Howard Lutnick, the Secretary of Commerce, conducted, he stated their plan, whether feasible or not, their plan with these tariffs is, we've heard Trump say he wants to eliminate income tax. Their initial plan is that if the tariffs work the way they want to eliminate income tax for individuals making $150,000 or less per year. We will see if that comes to fruition, but that's their goal. So if we look on the left-hand side, the left-hand side is the tariffs we've imposed on other nations. So last month we had 10% tariff going and was imposed on China. An additional 10% was put on those goods this month. We have a 25% tariff on goods from Canada and Mexico. And this week, actually, as of yesterday, we had an additional 25% of tariffs placed on all steel and aluminum imports globally. The overarching plan here by Trump is to place 25% tariffs on a mass of over $100 billion worth of goods from the European Union. And you'll see, I mean, this quote directly from Trump that explains quite clearly how he feels about the EU. Now, as far as tariffs being placed back on the United States, Canada, it seems like we're going tit for tat here, so to speak. And so Canada's imposed 25% tariffs on almost $21 billion worth of goods so far. Their plan by April is to extend that to 155 billion worth of goods. The EU is imposing a 25% tariff on 28 billion worth of goods. One of the things that was released this morning is the EU specifically plans to target whiskey and other American alcohols. So Trump announced this morning on Truth Social that he will be implementing a 200% tariff on alcohol, champagne, wine from France and the rest of the EU. And so really what we see here too, when we talk about tariffs morphing into trade wars, the Chinese embassy released a statement that they said was echoed basically by Xi Jinping. And it was, this is a direct quote, if war is what the US wants, be it a tariff war, a trade war, or any other type of war, we're ready to fight to the end. So the way to interpret these tariffs is all markets globally will perceive these tariffs generally as uncertainty and as conflict. And so global economists right now are saying, when we look at the stock market, right, the Trump bump is gone. We're below where we were before Trump got elected now in terms of stocks. And so they're calling it the wait and see market. The reason they're calling it the wait and see market, corporations for the most part have all their plans on hold. Multinational corporations, all their plans are on hold right now. And they're on hold because they have to be fluid in these situations. The overall goal by this administration is to bring jobs back to America. And the idea is if you buy American and you manufacture in America, corporations won't pay the tariffs and us as citizens won't pay more for goods. But if you're not willing to do that, you're going to get hit with the tariff. The real thing here is these effects on the economy, the global economy, could have long-term consequences, and we just don't know what those are yet. And so as a whole, like we were saying a couple slides earlier, when we have uncertainty like this, it's extremely bullish for metals, and it tends to be extremely bearish for paper markets as a whole. So moving on here, Another major thing that's affecting paper markets right now at the time is concerns about global growth and stagflation. So CPI, the Consumer Price Index, which was released this week, this is inflation as it affects you and I when we're at the gas pump, at the grocery store, when we pay our utility bills. CPI remains elevated at 2.8%, which is well above the 2% target that the Fed sets. But at the same token, while we have inflation still somewhat elevated, the economic data that's been coming out right now is dismal, for lack of a better term. We have existing home sales in the US at a 30-year low. Consumer sentiment right now, consumer sentiment shot up when Trump was elected because of the memories of the stock market boom from 16 to 20. We have consumer sentiment dropping to a 15-month low. Unemployment's up at 4.1%, which is still within what the Fed would call a normal range, but it's elevated higher than it has been since the pandemic. And most importantly speaking, we're not just talking about unemployment because of DOGE cuts and cuts to federal employees. We are mainly seeing this in small businesses and private sector jobs. The private sector jobs report that came out last week for February was down by almost 50% compared to projections. That is the biggest miss in jobs data in, I believe, over a decade. And when we're looking at the Federal Reserve Bank in Atlanta, they have a GDP Now model, which is widely looked at in the country as a great indicator for growth or contraction when it comes to GDP as a country. They are currently forecasting, as of this week, a contraction of 2.4% in the first quarter. And again, that is the worst since we shut down the entire economy. And so a couple of sound bites here too that I think are important. Howard Lutnick on Bloomberg this morning came out and said their perspective is it's short-term pain for long-term gain. They believe that none of these policies will truly have any type of positive effect for the economy until Q4 of this year. They believe the situation that we're in right now is a roll-off of the economy that has effects due to the money printing for the last 4 years, due to the stimulus over the last 4 years. And not to get political about it, but they name the past administration. And so Lutnick's comments are basically stating, the economic policies are worth it in the long term, even if they lead us into a recession here in the short term. And like I was just saying, Scott Bessent, the Treasury Secretary, was highlighting that, we're seeing an economy starting to roll a bit, and they believe that this is the inherited economy, not necessarily the effects of what they're doing right now. So moving on here, like I was highlighting, the Trump bump in terms of the stock market is completely wiped out, okay? Again, we're calling it the wait and see market. And so all major indexes are below where they were before Trump was elected. The Dow Jones, and this needs to be updated because now it's down over 9.5%. It's almost into correction territory at 10%. The NASDAQ is in correction territory. It's down 13%. The S&P 500, as an update, as I'm currently looking at the market on my other screen, it has now gone into correction territory. So 5 of the 11 sectors represented in the S&P 500 are down over 10%. 366 components, or rather companies of the 500, are down over 10%. Over 200 are in bear market territory. They're down over 20%. So this is going to have massive effects moving forward on the paper market. And so the major thing that I want to emphasize here is these effects are simply due to uncertainty in global markets. That uncertainty is going to keep hammering paper markets, and it's going to keep benefiting physical commodities, specifically gold and silver, because gold is always going to be considered what's called the ultimate crisis commodity, right? So moving forward, one thing that I wanted to emphasize here, all analysts across the board argue that the fact of the matter in the stock market is the Fed cannot come to the rescue this time. We know that the Trump administration is in favor and has actually outright demanded 0% rates. The reason they want cheap money is because currently the interest-only payments on the national debt exceed $2 billion a day. They're over $780 billion a year. So the cheaper rates are, the cheaper it is to finance the debt. The issue is with all this uncertainty, the Fed is frozen because they are unsure of how to react to this. They don't want to cut too soon because short term, those tariffs get passed on to consumers. And when those tariffs are passed on to consumers, effectively speaking, you see mass inflation in a short term. So they don't want to cut the rates and then have them raised again. So the Fed has effectively delayed all rate cuts until the latter half of the year. The CME FedWatch tool, great tool. You can Google it. You can click on each Fed meeting and it'll show you, based on votes from experts and decision makers at the Feds, what will happen to rates on a percentage chance. The CME FedWatch tool shows no significant chance of rate cuts until June now. If we get a cut in June, though, we're not looking at another cut until the fall, okay? The reason this is so important to consider is two things. The market requires rate cuts to bail itself out. The stock market does. But at the same time, when we talk about gold and silver, the number one thing that can, I apologize about that, the number one thing that can affect that can affect the gold and silver market is the dollar. And so when we talk about the dollar, gold and silver trade inversely with the dollar. So if the dollar falls in value, gold and silver go up. If the dollar gains in value, gold and silver go down. And so understanding the Fed's policies are key to this, because when rates are cut, yields fall, and so does the value on the dollar. Okay? Now, moving into here, this is the overall forecast from the CME FedWatch tool for the last meeting of the year this year. So the Fed is meeting next week, but the chances of a rate cut next week are below 1%. What the CME FedWatch tool shows us is we have the overwhelming majority predicting 2 to 3 25 basis point rate cuts this year. Okay, now with 2 to 3 25 basis point rate cuts, this could be great in terms of the national debt financing. It can help out. I know there's a lot of real estate investors here at Advanta. The thing to keep in mind is the Fed is basically staying higher for longer, and they're standing pat right now. There's too much uncertainty for them to make any type of moves until these tariffs kind of settle in, and until they get a better idea of how these tariffs are going to affect inflation and employment. They're dual mandate. So moving on, we were just talking about how important the dollar is. And so I want to review a dollar chart here, just at a high level. Just at a high level, the dollar analysis on a chart. One thing is you can see the effect of the election just looking at this chart, right? We had a Trump bump in all markets across the board. If you look at where the election was, we had the dollar at 103.35 on the index. We had it soar all the way up in the early new year here to over 110 points. Okay, now this is a typical head and shoulders pattern. And all you need to know about a head and shoulders pattern is it is the most important pattern to signify a trend reversal. Okay, so if you're in a bullish market like the dollar was here, a head and shoulders will signal a trend reversal to a bearish market. It also works the other way. If the head of this was below the shoulders, it would signify a trend reversal from a bearish market into a bullish market. Okay, and so what we've started to see here, looking at the chart, is the dollar is in an absolute free fall here right now. If you look at this green arrow pointing up from 103.5, the green arrow is suggesting what they would call a dead cat bounce up to resistance. Believe it or not, so this chart is from earlier this week. The dead cat bounce in the dollar was only good to send the dollar from 103.2 to 103.7. It never broke above 104 again. And so what is significant about this is the dollar has typically stuck within a range between 72 on the index and 105 on the index. Okay, and that's been while rates have been 0 to 2.5%. In this case, we saw rates go to 5.5%. And so the dollar hit a high when we had rates peaking over a year ago. The dollar hit a high of 115 on the index. Okay, now when we see in the bottom of the chart here, gold 3,200 to 3,500, and I will show a gold chart and projections from the banks to show that. The reason it is showing that along the blue line is critical support for the dollar on the index was seen at 106 and then 104. Now that we've broken down below that 103 barrier, the next level of support, of critical support for the dollar, is seen at 100. And once we break that, we're on our way down to 72. Now, the dollar on the index is not necessarily your purchasing power. That I want to emphasize. The dollar on the index is a comparison of global currencies: US dollars, Canadian dollars, Swiss francs, the euro, the yen, and so on. And so right now, the US dollar is getting weaker compared to all of those currencies, which is why we see it in a free fall on the index. And simply put, why does it show the blue line at 100 saying $32 to $3,500 gold? Well, we know as the dollar devalues, gold and silver go up in price. Simple as that. So moving on here, on to the next slide. One thing we are in the middle, and I know this is a chart I've referenced a few times in the past, is we are in the middle and gold and silver are benefiting from what is a commodity super cycle. Okay, it's not just gold and silver that are going up. Okay, included in that is all physical commodities. And so when we look at the situation with tariffs, with potential stagflation crisis that we're affecting, what's most similar to this on this chart is the line from the 1970s. Okay, this was the midst of stagflation and really a global trade crisis, as we had the end of the gold exchange system by Nixon in 1971 in order to try and achieve more fair trade deals for the United States. So when I say that, we're looking at a decade-long shift in markets here. This is not just because you haven't diversified into gold and silver since 2020. You have not missed the boat by any means. We are not even halfway to where we're going at the moment. And by most major banks and analysts' account, we have a good five to six more years of this at the moment, given current conditions. Okay, so I just wanted to highlight this because when we met in June, we highlighted major predictions made by the major banks. Okay, if we look at this, UBS was predicting $2,600 gold in 2024. We well surpassed that. Citigroup, as well as Bank of America, were calling for gold to hit 3,000 within 12 months last June. We are just at the precipice of that $3,000 figure right now. Gold is surging today. It's actually only $18 below $3,000. And so as I move on here, and I just want to make sure everyone can see the slide.
Yep, it moved.
If we look at gold performance through 2024, the total performance was a gain of 28%, but the gain as of just before the election actually hit 35%. The Trump bump and the surge in the dollar caused a small retreat in gold and silver markets, right? The dollar went up, so the prices came down a bit. The big thing to note is gold has been the #1 commodity for the last 2 years. And banks such as JP Morgan Chase are forecasting what they call a triple crown, for this to be the 3rd year in a row of gold being the top performing commodity. So moving on here, in terms of the projection, Bank of America has a $3,500 projection for gold this year. And right off the top, I will cite, this is significantly higher than other banks like Goldman Sachs, UBS. These other analysts see it at the $3,200 to $3,300 range, which is a gain of just over 10% from where it is now. $3,500 would be almost 20% this year from where it is now. And the thing I want to highlight is the reason Bank of America is so much more bullish than these other banks is because what they factored into their prediction is a 10% increase in investment demand. The reason they are forecasting this increase in investment demand is because China passed laws this year that Chinese insurance can now buy gold. And so they estimate that the Chinese insurance purchases of gold could total $48 billion this year, which would drive gold to its $3,500 target. Now, moving on, just to show kind of what we're seeing on the charts with gold, really, when we see this thick blue line at $2,800, that is the critical line of support for the market right now. More importantly, since we've crossed $2,900, $2,900 seems to be this new level of support. What we're seeing in the chart is, if you look at the current consolidation, it's beginning to form what's called a pennant pattern. And so the way to look at the pennant pattern is it's like compressing a coil or a spring in your fingers. The tighter you compress that coil or spring, the more of a whipsaw, or rather a blow off you have. And so we've seen in this chart, the coil's compressing. And today looks like the first day of the blow off, right? Right now we have gold up 1.5% on the day as it's starting to run. And so we're about to test that $3,000 barrier for gold. And one thing I want to highlight is 3,000 is a significant psychological barrier in gold. It might take a few times for gold to cross that, a few tries. Once it's crossed it, though, we're off to the races again. If you look at it, it's only a couple years ago that gold crossed through 2,000. Once we established 2,000 as support, we were off to the races, and now we're already looking at 3,000. So now I just want to highlight, silver quickly. We looked at last year, we were talking about a move to $35 by Bank of America. They were highlighting a move to $35 for silver. Other banks like JP Morgan were calling for an average of $30 last year in silver. And when we look at the actual performance of silver last year, we saw a total gain of 21.5%. It ended the year at $28.90, so close to the projection. But if you look at it just before the election, when we had the Trump bump, silver actually reached $34.72, which is a gain of almost 50%, and almost reached that target price last year, which is, significant. Last year was a great year for both gold and silver. So looking at the price forecast here, for silver. If you talk to major banks like, Citigroup, TD Securities, Saxo Bank, they're all forecasting silver to go over $40 this year based on the gold to silver ratio, which we're going to touch on in a brief second, as well as industrial demand. The London Bullion Market Association, the biggest bullion market in the world, they're forecasting $45 silver. Now, the main thing for silver is it trades in tandem with gold. Silver doesn't necessarily do a whole lot because it's silver, okay? Gold is the first mover and silver follows. And so what causes silver to move is when the ratio gets extended, we see big bullish moves in silver. All the ratio is the price of gold divided by the price of silver, okay? And we'll touch on that in a second. But I just want to highlight here the silver chart here. This is a cup and handle. It's a very bullish trend. You're going to notice there's actually two cup and handles here, a long-term and a shorter-term one. The big cup is multi-decade. This is 1980 to 2010. The smaller cup has been formed from about 2011 until 2020 with the handle blowing off. The depth of the cup here indicates the future performance. And so when we look at this, the depth of the cup here with a high of $50 and a low of $2.80 forecasts a $47 move. The $47 move would come from the bottom of the handle, which is at about $10.50. So long term here, we're looking at a move of silver, according to the cup and handle, of about $57 to $60, okay? And this is huge because what it suggests is, a lot of people see 50 as the top for silver, right? That's previously 2 times we've hit 50 and we haven't surpassed it. The main thing that makes this different, and TD Securities highlighted this, when silver hit $50 last, it took only 11 weeks between $30 and $50. It went straight up. And what did it do? It came pretty much straight down. In this instance, we've been above $30 for almost a year now. We've built solid support above that. And it's always better to have a market that builds lines of support and resistance, 2 steps forward, half a step back, okay? Now, just like what I was talking about, the gold to silver ratio, gold is traditionally speaking, it's steady Eddie, right? So gold is a very tried and true asset. Silver tends to be a little more volatile. What we do know is anytime the ratio gets wider than 80 to 1, silver outperforms gold 4.5% to 1. Okay, looking at this data today, the gold to silver ratio is about 89 to 1 right now. So if you take $2,980 gold divided by 33.74, what you're going to get is 89. Now, the reason we have forecasts for silver between $40 and $45 is if you take the price target of $3,300 gold to $3,500 gold, and you divide it by 53 to 1, that's going to give you the silver projection. And that's how the major banks do it, just so everybody knows. Now, here, and I just wanted to show this quickly, this is a standard allocation strategy that is called the permanent portfolio, so to speak. It's a 50-year study done on what type of portfolios perform the best. Over this 50-year study, what they found was that investors who had 25% of precious metals, 75%, when they say stocks, are talking about S&P for the most part, outperformed all other types of allocation strategies. When they looked at an aggressive investor, they're talking also about someone who has 6 to 7 different streams of income. And they're still showing 10% allocated to metals there. And then Ray Dalio, the billionaire, he founded Bridgewater, the largest hedge fund in the world. He himself has 7.5% of his portfolio in physical metals. So This next slide here is really just iterating the exact same thing. Effectively, what it shows is if you have more than 25% in your portfolio, you'll see higher returns. The risk, however, is that you will lose out on a potentially riskier opportunity that could yield you more of a return in the short term. Now, just before we end here, I know I mentioned a few things here about not buying coins. One thing I do want to mention is as far as the allocation goes, and everyone here can Google this and find the article, Bank of America has just changed their portfolio recommendation. They previously recommended 60-40, 60% in stock, 40% in bonds. They've now flipped it. They're recommending 60% in stocks and 40% in commodities, because commodities, including gold and silver, will be outperforming bonds for the rest of this decade. Now, I know I rushed through the last few slides there just because of our time constraint, but is there any questions that anyone has? Because I know we went over a lot of stuff here.
Yeah, Greg, great information. I know a couple people have asked already in the question box about the slides. I'll make sure that we get those, in a good format and get those emailed out to everybody who was listening live, people who were attended as well, to get that information. Those charts are great, Greg, and I really, like I said, really appreciate you being very topical, obviously, and adjusting the slides just within the last, with the information over the last couple of days. I think that was incredibly helpful. I did have one question that came in. I answered it all online, but I'll make sure in case someone didn't see it. Someone asked if you were holding gold in a Roth IRA account, are you permitted to take a distribution from the IRA of the actual gold bars, of the actual gold coins, rather than having to sell the metal and withdraw as cash? And the answer is yes, you can. We've had many clients do this over the years. You can take a distribution of the gold or the silver, whatever your precious metals, you can actually take that. And your distribution, then the taxes you may pay depending on the IRA that you have. In this case, the question was a Roth, where there wouldn't be, but the value is just whatever the value of the metal is at that time. We can have the metals directly sent to you. I think, Greg, you've had some clients do that, correct?
We have. The other thing I was going to highlight is you don't just need to have a Roth for that. We've had clients take the required minimum distributions from a traditional IRA in kind, where you can have your gold and silver shipped home to cover your required minimum distribution even. The one other thing I wanted to highlight too, Scott, from the earlier question, I didn't get a chance, the safety deposit box question. Mm-hmm. One of the things I would reference with safety deposit boxes, and this is not to be doom and gloom, it's just so you know the regulation requirements. Safety deposit boxes, for all intents and purposes, the gold and silver in there is not typically insured specifically by that bank. The other thing is they do fall victim to bank bail-in laws. And so no one's sitting here, preaching that your bank's going to go under next week or next year or whatever. But it is important to note, if you hold gold and silver in the bank vault and that bank has a liquidity event, they are able to bail into that safety deposit box to become liquid again. And so, one thing that I would say is, depositories are a huge advantage in that sense, because for the most part, they're cheaper. And if you ever want delivery, even if you're holding it outside of an IRA, if you want delivery of your metal and you have it at IDS, they will actually ship it. It's cost $25 flat fee, no matter how much you're shipping. They'll ship it FedEx 48-hour express right to your front door. So I would recommend, in an IRA, I would say you have to have it at a depository. But even if you're doing it outside, I would recommend the depository over a safety deposit box.
Yep. Yeah. And Greg, a question just came in. A couple questions coming in. We'll get to these and we'll try to wrap things up. But one of the questions talking about depositories is, how much does it cost to store the metals? And like I said, I know we work with a number of different depositories. We have one that's actually even in the Caymans, so that one's a little bit more expensive. But Greg, if you speak to what IDS SWP?
I was just going to say, are you talking about SWP in the Caymans?
Yeah, we've had people store metals there. Yeah, it's a little bit more expensive for what they do there, but the general fees that you'd have at IDS, at Delaware Depository, a couple of the institutions. Greg, maybe if you speak to what IDS charge, I think it's like $100 125
So
bucks a year, typically a
yeah,
starter up to for a certain amount of metals, and it kind of goes up a little bit from there.
yeah, it's roughly about 25 basis points of the account value. And so basically a way to think of it is for $100,000 in metal, you're going to pay about 25 basis points in fees. I don't speak for other dealers on this, but the one thing I will say is typically, and I know I've mentioned this before, we always try to offer a discount to Advanta clients who reference the webinar on their first purchase. Typically, we try to cover those storage fees for at minimum the first year for those accounts when purchases are made. But the fees are at IDS are 25 basis points. So for every $100,000, it's $250 a year in storage fees.
Yep. Another question came in. Someone asked if you can speak and maybe double two different questions. I'll wrap them into one as we wrap up. But someone asked, what is the minimum purchase offered by most companies? I don't necessarily know that. I don't work on the operation side and see all the transactions. So Greg, I don't know if you have a minimum purchase. And then someone asked kind of what the typical buy and sell spread is on silver. Maybe you can
Yeah,
speak to a little bit on that.
both good questions. One thing I would say is we, as a company, do not have a minimum purchase amount. I know for the most part, when it comes to IRAs with precious metals dealers, the number I see a lot is $50,000. Again, this is not us, but with other dealers and seeing their marketing materials and just knowing a few other dealers, typically it's $50,000. We've facilitated transactions for quite literally as little as $1,500 at Advanta, I think was one of the entry level ones. So don't think you don't need to invest $1 million if you want to get involved in gold and silver. When we talk about the spreads, the spreads in silver, depending on the project or product rather, could range anywhere from just under 1% all the way up to maybe 6 or 7% in some cases. What I would say is when we talk about spreads, and the reason I reference these coins, in the IRA world, we've seen other custodians that have had people buy these collector silver coins in an IRA, which again are not admissible. And they're charging premiums between 70 and 130%. So for me, if you're looking at metals dealers, if you're able to get a spread below 10% on physical silver, that's going to be probably the most competitive in the industry that I've seen, and that's typically our rule and where we want to be is well under that. For instance, if you're looking at a silver eagle coin, you're going to have a little bit of a higher spread than if you're buying a kilo silver bar, and typically they're ranging from about 1 to, I would say, 7 or 8% to answer your question.
Like I said, I'll grab these last two. Someone asked the presumed benefits of storing in the Caymans. I know from talking to the folks at SWP, some people feel that my metals are now outside of the United States. So if I ever need to access them, it's something where maybe the U.S. government would not be able to touch. I will tell you though, if you do that with your IRA is still subject to IRS and U.S. rules. But that's the presumed benefit. We don't make those determinations here at Advanta, but that's I think why people have wanted to do that.
I do want to reference the SWP thing. SWP, the benefits of it are kind of gone if you do have an IRA. The other thing I would say is if you're storing an SWP, while it's outside the country and you determine however you want to report that, neither Scott or I are tax professionals and going to give you tax advice. I've had clients store metal at SWP again. When you go to sell that metal, for the most part, dealers are going to require that to be shipped back to the United States. So they'll buy it in the Caymans, but you might face a shipping charge that you otherwise would not have to pay if it was in the country. And if it is in the IRA, it is all being reported just as if it was in Texas or Delaware, New York, or whatever have you.
Good point, Greg. Last question, Greg. Someone said the slides reference the portfolio. You think you shared it at the very end, the kind of percentage of allocations. How does a small investor accomplish that same ratio to really maximize their potential growth? Is the amount someone have affected? Did these percentages affect that, or how do they handle that?
That's a great question. I think the thing is when we talk about this ratio of allocation, you know, not to reference saying too much, but Rome wasn't built in a day. As you're building your portfolio, this allocation should be in mind from the get-go. It's not something where, you know, you build your investments up over 10 years and then you have X amount of dollars. You say, okay, I have a chunk of money, I'm going to diversify now. My whole thing is I would set it so that when you're contributing, you think to yourself, like, let's say you make an annual contribution of $7,500 or you know, 7,000 and change per year. I would want to split that up according to this allocation ratio, because you look at it over 10 years and you've done the same thing as if you took a $100,000 portfolio and moved 25,000 into metals and, you know, 75,000 into stocks, so to speak, if that makes sense.
Yeah, great, Greg. Great presentation, Greg. Great information. I know we've run a little bit over here today. Like I said, I will share the slides to with everybody who participated today. Get those slides out to everyone with the recording if you want to go back and listen to the great information Greg shared with us. So, Greg, thank you again very much for coming on. Greg's contact information was on those slides if you want to reach out to him. You can get it from there. Greg, if you want to just give your number out, that's fine too.
Yeah, no, of course. And thanks for having us on again, Scott. These are great. The direct line for our office is 561-284-6443. My email as well, it's real simple. It's just greg@allenhousemetals.com. And don't feel just because you call or you have a question, it's not like you're locked into buying or selling or doing anything like that. We're happy to educate people on the metals markets and markets as a whole. So if you need any help with anything like that, feel free to give us a call or shoot us an email, and we're happy to, you know, pitch in and you know, teach you how to analyze a few things and answer any questions that you have.
Good. All right, Greg, thanks so much. If anyone has questions on the IRA side of things, here's my contact information. Another great webinar. We're going to sign off now. Again, Greg, thanks very much for coming on and sharing your knowledge. We'll probably look to, we'll see how these next few months go. Maybe have you come on again sometime in the fall and see where we're at.
And I'm sure it's going to be completely different than what we're talking about now. And again, thanks again for having us on, Scott, and for everyone attending today.
Yep. Thanks everyone for attending. And if you have any questions, please reach out to Greg or reach out to myself. Good day.